All right, guys, we're beginning the week Monday, June 10th. Bullish open. Room was 58% bullish. The overall market probably was. We open up at this yellow line rally. Here's the thing, though. It's not about being right. It's about how long are you wrong for. Are you good at being wrong and you're not wrong for long? So in here, I was bullish looking for another breakout. This was some chop. If you guys look at this was some good sideways rotation. And then we had a chance to blow out 95s and go up, right? When you have a chance to go up and you do, great. When you have a chance to go up and you don't, look out below. All right. So I'm not going to replay this with Sierra's replay feature. I'm just going to go through it bar by bar. Couple things. You have some green buying in this range here and here. Through there, you got to be careful. When it gets through these greens, you got to be careful. All right. They should have went through the top of this range on this push, and on this push. So they should have. And then another green comes in, another push that they should have. And it was all in here, these, especially these three, let alone this one, that you should have been able to take out this consolidation and make another leg higher. When they finally get through these green edge zones, which are where buying comes in, it becomes a lookout below moment, and that was 94. I said if I wasn't long in through here, I'd have been short. And not to be funny, it's just that if I wasn't bullish looking for the upside in a good location, probably would have been selling to get short instead of selling to get out. But selling to get out of a long is a great skill because you either could take profits if you have them or scratch and break a trade off even if your location was around 93 half or 94 half, instead of holding this damn thing all the way back down to wherever it's going to go. And it ended up going back to the open and bouncing, but you don't know that. All you do know is that you're long from here and you didn't see this transition in the market you're trading. How could you anticipate it's a transition? But for crying out loud, it couldn't get through all those rotational pushes, and then you got some where these green buying coming in gets below it. It's like, well, these guys can't be too happy. What guys? All these green imbalances where buying came in, they can't defend it. All right, that's number one. Number two, you look at the NASDAQ. At the same period, the NASDAQ makes its drive higher, and the very next bar, wham, takes it all back. That wham takes it all back moment is when you put yourself in a position to coordinate that this is also going to happen. There's some downside to this push lower. So you got it moving through some of the upside flows that you had in here, and then you had market correlations of the NASDAQ really getting longs pissed off when it goes up and then back down in this sequence in here. All right. Now, a moment I do want to replay is just after 9 o'clock Central. All right, I'm not going to replay this. I fast forwarded to the area I want to talk about. Two things are going on here. What we do know is that this is a consolidation box. We also know that this is the middle of it. We also know that the NASDAQ the ES just popped through it. We also take a peek at the NASDAQ. And the NASDAQ at that time, this is about 9:41 Central. All right, the NASDAQ also was approaching the center of their consolidation box. I teach about consolidation boxes all the time. And when people finally understand it and see it, that's where the fights are happening, their eyes open. So this is, pay attention to the right side of the screen as I'm moving it forward. This is the consolidation box that we're looking at. We don't know it's going to rally like this, but what we do know is that this is a consolidation area. This is where they can't get through the upside, but they also can't get through the downside. They make an attempt to go through it right there. And what we do know is what's the center of this fight. The center of this fight, as we mentioned live in the room, was 33, 34 even. And so we get through those, that creates the probability of that upside. When you take that and you start reading that in here. When you start reading that and seeing it, it doesn't become random anymore. Right there, when you see this pop, this doesn't become random anymore because you took that into effect. And then another thing you looked at, the ES, they had the center of their consolidation taken out a step or a moment before the NASDAQ. And they also created some red edge zone selling. What does that mean? Well, on this subsequent turn back up, I said, if you're short, you got to be really careful. If you're bullish, you got to, this is your win moment because the NASDAQ just jumped. They had a quick jump right through those 34 evens I just mentioned. And then it gets through this red. When it goes through a red, generally the upside is the right side, and you could go up to your next target and create your next move. So a couple things with this. You identified a congestion area, you identified where sellers might be stuck above, and then you tied two markets together in order to make a more informed decision. And then most importantly, the damn thing started working sooner rather than later, because price is the first thing that's going to tell you if you're good, bad, or okay as far as your location.